for REI for Pro. Thank you for starting that. Should I start over?
Sure.
Welcome everybody to Real Estate Investing for Professionals. My name is Daniel Homand, and we are a group of people that have regular jobs at corporate America, but we all love investing in real estate. So this network is provided to bring in great speakers and to have a great educational time together and to learn and discuss our real estate that we are working on as a community. So it's all about education for busy people who don't have a lot of time to spend, but are looking for building their passive income or their active income, depending on how they wish to invest. My company is Good Samaritan Capital. We invest in inflation hedged cash flowing multifamily properties. We're in 8 different states and currently hold about 1,700 units. And we are going to go through and introduce the other REI for Pro leaders here. So perhaps we could pass it off to Misi.
Sure. Thank you, Daniel. I'm Missy, and I host the Walmart Real Estate Investment Club. Started that a couple months ago, so hopefully some of the Walmart folks are here too. Excited to see everyone. Actually, I do very similar things as Daniel in terms of we're a private equity firm, Life Mission Capital, and thank you, Matt, for the link there. And one of the special things about us is I have a data analytics background, and I use that to help our investors to do great due diligence on the market, the sponsors, and the properties. Happy to learn and share my knowledge here as well. Thank you.
Hey, I'll go next real quick. So my name is Matt Ford. Thanks everyone for joining. I, like everybody else on the phone, have a W-2 job. I work at Dell Technologies. I'm a regional sales leader for Ohio, West Virginia, and Kentucky. But my home base is Nashville, Tennessee. Like most of the folks on the phone, I am a passive investor mostly. And you can find me on my podcast link that I'm about to drop right now. It's called Ice Cream with Investors. Our guest speaker today is Jamie Bateman. He has been a featured guest as well. So go check out that episode and I'll make sure I drop that. Priya, I'll turn it over to you and we can get going.
Hi, everyone. Welcome. Similar to Misi, Daniel, and Matt, I'm also a passive investor and I work full time at Netflix. Similar to what Misi said, I'm an auditor by profession. So that gives me a little bit of an advantage when it comes to looking at underwriting and evaluating deals. So currently we have invested in 500 plus units as co-GP, my husband and I, in Texas and Atlanta. So looking forward to growing our portfolio and learning more and hopefully sharing with this group and learning from your questions. Look forward to the rest of the conversation.
I think we saw Mason on the line too. Are you on the line, Mason? Or anybody else from REI for Pro? Keshev? Okay, I thought I saw his name. Let's introduce Jamie then. Jamie is an investor in mortgage notes, and he's going to talk to us today about how to invest without actually owning property. And so, Jamie, I will let you introduce yourself and welcome to Real Estate Investing for Busy Professionals.
Thanks for having me, guys. I appreciate it. Just so happens when Matt asked me to come on, I had recently prepared a presentation for an upcoming event that's going to be all virtual. It's called the Cash Flow Expo. And it is, I think it's their 4th annual. So I recommend you check that out. It's largely note investing centered, but they also have some other asset classes and strategies. So my name is Jamie Bateman. I invest in mortgage notes, and I'm going to get into the specifics of what that means. I'm sure some people on the call are very familiar with mortgage notes and others are not. So we're trying to keep it basic, and we can drill down if we need to in certain areas. And actually, I think I'll just start the slideshow, and the second slide is about me. This whole night's about me, right? I'm kidding. Okay. Can everybody see that enough?
Yes, thank you.
Okay. I'm just going to keep it on this here. So notes for newbies, a Q&A. It's primarily set up as a Q&A. We're going to go through the slides and then take some questions like you guys normally do. So this is a little bit about me. I'm a former collegiate lacrosse player, coach, U.S. Army captain, did a few different things in my in previous phases of my life, I guess. And I am a co-host of the Good Deeds Note Investing podcast. I own Labrador Lending, which is our primary note investing outward facing company. And I am also a co-founder of a new loan servicing company. And I also co-manage a note fund that we'll get into. I started in real estate investing actively about 10 or 11 years ago, 2009, 2010. And primarily as a rental property, landlord at that point. Previously, I'd worked in the title industry and the mortgage industry for a mortgage broker. Didn't get into mortgage notes until 2018, but since then I've been very active in that space. And you can debate whether note investing is passive or active. Really, just like many things in real estate investing and in life in general, it depends. But I've been heavily focused on mortgage notes for the last 4 years. So the basics: what is mortgage note investing? It's a niche within real estate investing. I'm sure most on the call are familiar with what a mortgage is. A note is a promise to pay. The mortgage itself is a security instrument that links that note to collateral. And in our case, we focus on first position mortgage notes. And we'll get into some of the nuances there. Mortgage note investing is buying the debt. Okay, so we don't originate any loans, but we purchase already originated notes, and we own the debt. Like I said, I do have a portfolio of rental properties, single family rentals. I know, Matt, you poo-poo on single family rentals. I'm just kidding, but that is still a very, very much a big part of our own personal portfolio from a cash flow standpoint and other standpoint. But so I do like owning equity, put it that way. But in this case, we're focused on purchasing debt and kind of not having to deal with tenants, toilets, trash, all that stuff. And we'll get into that. So I have a lot of free content on my website, and we're actually redoing the site right now. It should be ready in a few days. Not trying to sell anything to anybody, but we've got free blog posts. If you really want to dive into this, I've got a lot of blog posts, a lot of free content. I mentioned the podcast. And just like any asset class, there are pros and cons. I love note investing. I mean, I wouldn't be devoting so much time and energy to it if I didn't like it. But there's no perfect asset class or strategy. And so there are reasons to get into notes and there are reasons not to. Some of the things, and again, this is kind of geared towards basics for people who may want to roll up their sleeves, so to speak, and become more active in the note space, but it obviously applies and appeals to more passive investors as well to better understand what they're actually investing in. That's always a good thing. So do you want to invest in notes or do you want to be a note investor? So again, active versus passive. You can absolutely buy a performing note, and we'll get into this, but performing note in your self-directed IRA, which I do recommend for people that can do that, since frankly, notes and debt have no inherent tax benefits. But you can buy a performing note in your IRA and be very much invest in notes, or you can also invest in a note fund. And one of the blog posts we have goes into great detail about how passive and active note investors can work together. It's a really thorough post. Or do you want to be a note investor or run a note investing business like we do? I mean, obviously, ends up being a lot more passive, more active, so to speak, even though you can do it from a laptop. Performing versus non-performing. This is just some of the kind of, language in the, I guess, lexicon of a note investor. We like to put everything, I think in general, people like to put everything in one of two categories. Not every note fits neatly into one of those two categories in reality, but A performing note, it means the borrower is paying, right? So I kind of liken that to a buy and hold rental. And again, obviously different in many ways, but a performing note is one where the borrower is actually making payments on time every month. Non-performing, you can figure that out. They're not paying, right? So, or maybe they are paying on some level, but they're way behind. So again, much gray in this, but that's kind of the, performing, non-performing are the two buckets that people like to put notes into. And it does help with bidding on notes and things like that to understand some of the differences there. So typically speaking, we'll say non-performing, a loan becomes non-performing when it's at least 90 days behind. And there are many different exit strategies with note investing, just like there are with other asset classes and strategies as a whole. On the non-performing side, you think of that more like a fix and flip, where you're adding value to that asset and you're able to exit in one way or another, whether that's through the borrower or through the property. Whereas a performing note, you're buying for cash flow, consistent yield. So note investing advantages: diversification. You're able to avoid market volatility, which I'm sure right now I feel like I have actually gotten quite an uptick in the last few weeks with people reaching out to me just to kind of from the passive side to learn about notes. Coincidence, whether that's related to the stock market and crypto and all the volatility we've seen, who knows? But I think at least some of that interest is because the note investing is not tied to Wall Street, and you can diversify your investment portfolio in some way by investing in notes. So it can be a win-win for the borrower and lender. That's also another advantage of being a note investor. We're not Chase Bank or Wells Fargo, where we're able to actually work with borrowers, and that assumes that presumes the borrower wants to work with us, and there's communication there. You can't work with someone who isn't talking to you and doesn't want to communicate. So it's not always possible, but where we can, we like to work things out with the borrower. And that's something that, we have more time and energy to focus on each individual asset as compared to the big banks. You have control and security. Again, there's collateral. Apple stock does not have collateral. The whole thing can tank tomorrow. In this case, the real estate is the collateral. And so I do think this is a recession resistant asset class. And one of the big ones that people really do like is the opportunity to work from anywhere. My co-host Chris Seveny and I on the podcast, we like to keep it real, I think, and people appreciate that. Again, I've told you there are downsides to note investing. So, and so gurus out there will like to sell certain things about note investing, sell the lifestyle. You're going to be a millionaire in 3 months, whatever. But so a lot of the things that you'll hear maybe are not true. The passive thing gets thrown around a little bit, but a little bit too much. But the opportunity to work from anywhere is absolutely true. I have my home office, but as long as you have a cell phone and an internet connection, there's no reason you can't be an active note investor. So getting started, and then again, this is geared more toward active note investors. But where do you find notes? That's a $1 million question. It's just much like real estate. This is a very inefficient market, and it's all about relationships. There are note brokers out there, but I've found a good source of notes to be other note investors. You might have a hedge fund or another note fund that's closing, and they need to liquidate. They need to sell off notes, and there may be nothing wrong with those assets themselves. So there are online exchanges like PaperStack, and they can be good. But if you're going to scale on any level, you really need to start working to be more of a hunter versus a farmer, especially in today's market conditions. It's deal flow is a real challenge. So finding notes has been a challenge, frankly. pricing is kind of crazy right now, just like across real estate. So out-of-pocket financial commitment, when to use other people's money, when to do joint ventures, partials, if you want to get into that. Again, there are a ton of rabbit holes we could go down, and I'm happy to answer questions. I sell partials. Someone on this call knows that. But partials is a good way to, if you're not investing in a note fund, but you want to be more on the passive side, you can buy a partial, and there are different ways to do that. A partial just simply means instead of all of those the whole full payment stream, you're buying maybe 3, maybe 4 years of payments. And it can be much more passive than actually buying a whole note yourself. And then again, just like any business, frankly, whether it's real estate or if you're trying to scale, more times than not, you're going to run out of your own cash, or maybe you don't even want to use your own cash. I mean, so eventually you're going to need to figure out how you're going to use other people's money. And so, and you all are familiar with that from being passive investors. And we do run a note fund. I'm going to be opening up another note fund here later this year. So that's a good way to scale as well. So these are key decisions. I'm not going to spend too much time on this slide. These are really key decisions I came up with just for kind of the more quote unquote active note investor. How active do you want to be? Do you want to own a couple notes, or do you want to really scale? First or second position. There are note investors who only buy seconds. There are note investors who buy firsts and seconds. And I'm thinking most people know what a second mortgage is on this call. A lot of times those are HELOCs, and you can get in a little bit that's a little less cash capital intensive up front. Seconds are generally cheaper, and typically you're obviously you're one step further from that collateral, so it's a little bit different of an approach. And oftentimes you're focused a little bit more on the borrower when you're doing your due diligence and when you're doing your underwriting, as some people like to call it. So a lot of people will say that in first you're focused more on the property when you're doing your due diligence, and in seconds you're focused more on the borrower. Frankly, we look at both when we're doing our due diligence. So picking a handful of states, I don't, if you pick one state that you want to invest. So this is one thing that's very, very different. Each state, the note investing in each state varies wildly. So, and I think this is one thing that's different about notes versus real estate in general. And real estate obviously can be very different based on different markets. But in notes, for one, I mean, we do invest primarily, we do buy notes primarily in the Midwest and Southeast, just like a lot of real estate investors are focused on the South and the Midwest, if you're more of a cash flow investor. But, because of the laws, they vary so much with foreclosure. I mean, everything varies by state heavily. So it's something that honestly, when I get into it, I kind of underappreciated, but where are you going to invest? It really is a big one. And, that may come down partially to which notes are available. Are you going to buy CFDs? We're not going to get into this, but I can talk all day about CFDs. Their land contracts are CFDs. They are a form of it's a form of owner financing where there's shared equity between the borrower and the lender. From the note investor standpoint, they are more work. They can be more liability as well. Comes with a lot of headaches, and there can be some more upside, but many note investors won't even touch them, but we do buy them. And then performing versus non-performing. Do you need cash flow, or are you looking more for, that big payout at the end? So I'm just going to go through two case studies. And again, there's way more information on my website and about these. This one, I think we talked about, Matt, on your show. And I actually think I said I did a foreclosure, but I just afterwards, I'm like, wait a minute, it didn't actually go that way. And no, I wasn't lying. We were proceeding with foreclosure, but it didn't actually turn out that way. And so it was actually a deed in lieu. So I've never been to Jacksonville, Florida. I'm in Maryland. This was my first true non-performing note that I bought. And I'm not sure, just keep me on track with time. I'm not sure how much time we have. But this was a non-performing loan that you can see some of the details here, that I bought in April 2019 and paid 46.5. Actually could have, it turns out I could have bought this for 40,000. I found out kind of through a back channel later, but unpaid principal balance of this loan. And this will be a really good example for a lot of aspects of note investing. The unpaid principal balance was about 94,000. The total payoff was approximately 132,000. So this is what the borrower owes if she wants to pay off the loan. And that's due to arrears, the difference. So many years of not paying. So she actually had a tenant in this property and it was really filthy inside. And she's collecting rent from the tenant for years and years and not paying her mortgage. And the previous lender had attempted to work with her to modify the loan and still didn't work. And again, people, trust me, bad things happen to good people. That's one of the most challenging things in this space, is to figure out, which borrowers you can work with and which borrowers you should work with. I'll just leave it there. But so we ended up doing, so I'll just kind of from memory walk through it, but we tried to work with this borrower. There was very little communication. It's one of those, I'm going on vacation for 2 weeks. I can't talk to you about this. It's like, okay, well, that's not okay. It's like,
Yeah.
So we ended up pursuing foreclosure. We were in Florida. Now, one thing I didn't mention is states can be they're either judicial or non-judicial. And so Florida is a judicial state and can be expensive and time consuming to foreclose. It's one reason some note investors don't buy in Florida, but it's obviously a hot, real estate market, and you can find deals there. And so she didn't want to work with us. And so then it probably was a year or so of trying to work with her, almost at the foreclosure finish line. And then she did a deed in lieu. So deed in lieu of foreclosure, for those unfamiliar, is where the borrower or homeowner will deed the property over to the lender in lieu of foreclosure. So we ended up forgiving approximately $25,000 of debt. If you looked at kind of the property value and her total payoff, she was underwater, which you're not seeing too much these days. But and she avoided foreclosure on her credit and everything. So it was good for her to do what she did. We ended up doing a long distance rehab. Again, I've never been to Jacksonville, but I don't necessarily recommend this for people, but we ended up doing a long distance rehab, put equity in the property, and ended up finding, now this is actually a rental property for us in Jacksonville. And so I like to look at this as a win-win-win all the way around. I mean, it was good for us for sure. It was good and this was not a joint venture or anything. It was just our own cash. It was good the occupants were just living in an awful situation. It was like bed bugs and just disgusting. And so we rehabbed the property, added value. Yeah, really gross. Added value to the neighborhood, added value by offering affordable housing, which is obviously in short supply right now for the new tenants after we rehab the property. And now we have a rental property. And so they don't all work out this well, but they certainly don't all work out this well, but this was a home run for sure. We just recently, it doesn't say it on the slides, but a month ago, this appraised for 173, which is nuts. And we did a cash out refi and got even more. I'd already gotten all of my money back, but got even more of it back. So
great, Jamie. That's a great case study that you shared. We actually had some great questions coming in the chat as well.
Okay.
I just summarized them and put them in the chat here. So I'll just fire them to you one by one if you'd like.
Sure.
So the first question,
Go
go
for
ahead.
it. No,
Yeah.
go for it.
Great. The first question is, where do you find notes to buy?
Yeah, it's a tough one. I have, you're not gonna, that's the $1 million question. There are online exchanges, paperstack.com, notesdirect.com. I've got a whole list of online exchanges. I don't spend a lot of time there, frankly. You can find them there, but for newer note investors, I do recommend that. And on some of those sites, you can run due diligence, kind of practice due diligence, and it's nice to see what notes are trading for. But in general, it's it's relationships and networking. So some of the gurus will teach that you should go out and call big banks directly, and I've never seen anyone who's at our level successful with that. It takes, it trickles down. So you need to look for note funds that are closing, hedge funds that run bigger portfolios, that for whatever reason are getting rid of their notes. That's a lucrative source.
Got it. And so basically, you're connected with the right people who can help you with those opportunities.
Yeah, it's very inefficient, but there are opportunities if you're willing to work for it.
Yeah, find the who, not the how. Yeah, definitely. And the second question is difference between judicial and non-judicial.
So judicial is, I'm really trying not to say it depends, but because I say it all the time, like an attorney, but because some states like Maryland is kind of both, but judicial is where you'll see a mortgage and the foreclosure process goes through the judicial system. Non-judicial is typically a deed of trust, and you're going through a trustee, and so many new note investors will avoid judicial states because they can be much more expensive and time consuming. So New York, for example, I've got several loans in New York, and its taxes are high. It's just a very long foreclosure process because it's an expensive judicial state. So hopefully that mostly sums it up. Judicial foreclosures go through the judicial system.
Got it. And if anyone have additional questions, feel free to put them in the chat. The next question, I like to move it up, is basically understanding what the returns are like. A lot of us are more familiar with, cash on cash return, the average annual return. So in this example, would you say for how much, let's say, how much did you put in and how much did you get back, and on an annual basis? Maybe just break that down for us a little bit, and then we'll have some other questions in more details of the fees and splits, and etc.
So this is where it is helpful to split things into performing, non-performing. Performing, and most note investors will bid based on yield. So, which is, people argue whether it's different than IRR. It's really not, but I'm sure there are plenty of people on this call who can school me on the differences. So yields for performing notes, they've come down. And if you're looking at a strong performing note with a real strong pay history and with equity, you might end up getting maybe a 9 to 11% yield. We typically target 12 to 15% when we're buying performing notes. And that's not talking about funds or any, that's just me going and buying a performing note. And then from the non-performing side, it's anybody's guess, honestly. People mostly bid at more based on percentage of UPB versus yield. And again, you can get into disagreements all day long about how you should bid and things, but non-performing notes, I'm looking at one, I'm closing out one in New York that I'm going to lose money on. So it's like, it can go anywhere from actually, I have two more slides that are another case study, but and in that case, my return was actually infinite because I didn't have any money in the deal. So short answer, I'd say let's just target 12% for performing notes and up to 30% for non-performing notes. If you're asking me from a passive investor standpoint, we run a note fund, and you can structure it many different ways, just like other funds, right? So we run a note fund, and we pay a preferred return between 7 and 11%, and that's based on the amount of capital invested. And then we also pay an upside split. In that case, for our fund, it's 25% to the passive investors. It could be any, it varies greatly.
Got it. And another question is more on the examples you mentioned earlier about is the 3% fund management fee before after the 7 to 11 pref return? And then also why is the upside 25% investor and 75% manager?
I mean, this is our fund, which is closed currently. Yes, the 3% is before that. And then why is it? Because it kind of aligned. Basically, we just structured it. So this is my first note fund that I'm running, and my business partner, this is his 5th or 6th, and he's made the mistake of structuring some funds that didn't have enough of a upside split for him, frankly. And so don't get me wrong, his investors have done very well, but this is just how we decided to structure our fund. It could be a 50-50. Most joint ventures are 50-50, where you've got the quote unquote passive investor and then the day-to-day manager. Technically, they're not passive in a joint venture, but most of the time those are 50-50. You can do a fund where it's 50-50 split, just like a big joint venture. In this case, we decided to, encourage more capital invested by offering a higher pref for that larger capital investment, and then slightly less of a split. But again, our fund is closed. I'm actually going to be running a performing note fund, and I've had a lot of people asking me about this, as far as people are just looking for safe, quote unquote safe, nothing's without risk, but safe places to put their money and get a stable return. And so that's the way I'm going to go on my next fund.
Okay, that makes sense. And in our syndication business, similarly, it really depends on what are the comparable opportunities out there offering in terms of the total returns, and how can we be competitive but also comparable at the same time, and that will help determine the splits as well. I know that
one of the
other
things,
hosts. Oh, go ahead.
Sorry, just one of the. I mean, and I've invested in multifamily syndications and myself, but you're not, in this case, it's typically a 3-year wait, and you're not, some of those multifamily syndications or other syndications can be a longer 4, 5, 6 years, and there may not be as much cash flow, and so it really depends on what you're looking for. Note fund is not going to offer tax benefits, so multifamily syndication is. So again, pros and cons to everything. It depends what you're looking for. This is a way to diversify, and it offers collateral. The other thing with the syndication that I was going to mention, it's oftentimes one property, right? When I say, multifamily syndication is normally one big property or one big deal, whereas we have currently maybe 40 notes in our one fund. And so your risk is kind of spread out among those notes.
Yeah, it all depends as well. You can also apply a fund structure to multiple syndications. I know that a few other hosts also has questions. I'll pass it on to Priya and Daniel on their questions on this area.
Thanks, Missy. Jamie, I had a couple of questions. Maybe you're going to cover that in the subsequent slides, but I'll just put it out there anyways. Sure. So typically 2 questions, basically. So what is usually a holding period for some of these investments? And the second question is, how do we choose, like, any pointers on how we can select notes that we should be investing in?
So first question, performing notes I buy just to hold, really, for cash flow, keep the lights on, keep the business running. I mean, just I don't buy them with the intention of exiting them. And these days I am focused more on buying non-performing notes. Those typically you can assume it will take anywhere from 6 months to 24 months. I'll say 18 months is a normal, no one expected the pandemic and all the moratoria, right? And so that's been increased, that timeline. So, if you're depending on how you're exiting, it depends. 6 months to 3 years. And the second one, I'm sorry, what was it? How to decide which notes to buy?
Yeah, exactly. Any pointers, any do you have like a cheat sheet to be like, hey, here is where I would go versus
yeah. I mean, I would say the 5 key decisions is a good starting point. My first of all, do I want to be a note investor? Like, I've mentored people who one day they're sending me an Excel spreadsheet with, oh, I just bid on these 12 notes. Were these good bids? And then the next week, this guy was asking me if he should do short-term rentals, or and I'm like, we got to back up. You should not be bidding right now. So, that's just, get educated first. You never stop educating yourself, but don't just jump into notes. I mean, yeah, it depends. That's too much of a rabbit hole, frankly. And really, like, what I did was I was more of a passive investor initially. And then I decided I wanted to be more of an active note investor and run a business.
Thank you. That makes sense. I think Daniel had a few questions too.
Yeah, I heard you mention selling a partial at one point, and I just wanted to go back to that and ask, what's some of the strategies? First of all, what is that? What are some of the strategies around it? And also, what's the mechanics? How do you go about selling part of a note?
Yep. So it depends. Matt knows that my partials that I sell, it's very passive for the other person. So a true partial, you get your, we haven't talked about loan servicers other than the one BiFi that we started, but a true partial, Matt is, I'm just using you as an example, Matt, I hope you don't mind. But Matt buys a partial from me and he actually takes over the management of that note for X number of payments, right? And the servicer is involved in that process, and the servicer is the one who collects the payments. We use third-party licensed servicers to collect payments and deal with, compliance issues and things like that. But the way I do my partials in reality is more of a blend between, and this is really in the, in the weeds, but between a hypothecation and a partial. So I still manage my partials myself because I have a strong interest in how that note ends up on the back end. But the way it looks, really, to just kind of back it up, is I sell partials at a specific interest rate. And so there's a loan amortization schedule that goes with that sale of that partial. So let's say you have 10 grand. A lot of times what it ends up being is non-accredited investors that are looking for something that's passive and they can't find a good note fund, and I'll sell them partials. And I have accredited investors who buy partials as well. But so it's very flexible on the front end. You tell me how much, and I don't actually have any partials to sell right now, so this is not a sales pitch, but you tell me how much money you have to work with, and we agree on I'll just, honestly, how I do it is I'm selling partials at 8%. It's super passive, and you get your principal and interest, you get your principal back along the way. And it's amortized over typically 3 to 4 years is how we do it. You can think of it almost like a loan to my business, frankly, but that's, again, it can be super passive or less passive. But you're taking your, say, $20,000 and you're buying the front end of those payments, right? So you're buying a stream of payments for a period of time. that's a way for me to scale my business. I can take your cash and go buy another note, or put it with somebody else who bought a partial and buy another whole note. And that's a way for me to kind of defer that payment stream and go buy and scale. Hopefully that makes sense.
And then my other question was, what exactly are the tax implications of the income you derived? Are they taxed at normal income rates, or
Yeah,
are there special deductions or provisions that you could take advantage of?
it's a good question. Unfortunately, I haven't come across any. I just tell people it's just assume it's going to be ordinary income. So again, that's why the self-directed IRA, or if you have an account like that, whether Roth or not, or any kind of, we say IRA, but there are a lot of other options, as I'm sure you all are familiar with, EQRP and things like that. Those can be a great way to go for the passive investor. And that way, personally, I don't use self-directed IRAs or self-directed accounts to buy hard real estate. You can run into UBIT and other issues with that, and you're possibly getting rid of that depreciation benefit of owning hard real estate when you're using a self-directed account. So short answer, it's not, note investing is not tax friendly.
Nice.
Hey, Jamie, can you go up one slide?
Yep.
So I just want to kind of jump in here and kind of talk
Yeah.
about why I'm interested in this space. So first of all, when I first learned about this space, I was thinking, who would go buy notes from a bank at 4% when inflation is 7%? And I was talking to a friend the other day, his mortgage is 2.65%. I mean, that is ridiculous. Why would I park my money in 2.65 buying that from a bank? I think the difference, as I learned more about this space, is controlling an asset. So wealthy people don't buy assets, they control assets. And I think this slide kind of hits home to that. First of all, when we're talking about the note space, most of the time, at least the area I think you play, Jamie, we're talking about seller finance notes. And we're talking about,
Yeah.
Yeah, we're not really talking about Bank of America writing the highest credit or borrow out there. We're talking about fix and flip. Somebody puts it on a seller finance note to the person that bought it that might not be able to qualify for a mortgage at a bank. And that paper is at 9 to 10%. And then Jamie's going in and buying that. So this slide indicates that pretty well. This property is worth 135,000. The unpaid balance on this was 93,000. Jamie in this strategy is going to go buy it at 46 or control it at 46. So essentially, Jamie, you got control of a single family asset for $135,000 for $46,000. And if the borrower keeps paying, great, we're all in it. If the borrower doesn't keep paying, then you have a little bit more flexibility than a bank does, because now you can go in and say, hey, Mr. and Mrs. Borrower, what can you pay? Can you catch up some of the bad loan that you have, some of the outstanding debts? Can we reduce your payments? Can we negotiate? Because you are the bank at that point. So I just wanted to highlight that, because I think this slide does a really good job of saying, when we're buying a note, we're not buying your mortgage note at 2.6. We're buying seller finance notes for the most part, and we're controlling an asset that usually has a higher ARV, and we're just undercutting it on the purchase price.
Yeah, I mean, so we do buy. There's many ways I could go, but that is another big question when you're getting into notes. Do I only buy some note investors will only buy institutional paper, so bank originated loans. We do buy both, and contracts for deed technically are seller financed notes, so we do buy those. We don't normally buy fix and flip loans, but certain people, some people, that's their whole niche. But absolutely, to your point, Matt, you're buying at a discount, and I really didn't drive that home yet. So especially in non-performing notes. So a non-performing note will typically be bought, and this varies greatly, depends, as we scale, we get better pricing because we have more capital and we can take down a larger, they call it a tape, larger pool of notes. So I'm starting to get better pricing than I got before, right? But non-performing notes typically trade at let's just say 50 to 60% of unpaid principal balance. Now this payoff was considerably higher than the principal balance. So I was told shortly after this, I could have bought this they were willing to sell it for $40,000. So I could have bought this loan that the principal balance was, well over twice what the price would have been, We'll just say it was twice what I paid for it. And then the payoff was considerably higher. So with the UPB, unpaid principal balance, the difference between that and the payoff, you're much more, nothing's guaranteed, but you're much more likely to get back that principal balance than you are anything between those two numbers. So most non-performing note investors will focus heavily on the principal balance when they're bidding. Then they might also kind of say, oh, there's also 30, 40 grand that I might get back as well. And I didn't get all that, right? When we got this property, it was worth about 105. I don't know if it's not in the slide, but so I paid 46 and the property was worth about 105. We put 25 into it. And then now it's worth supposedly 173 or something or whatever. I don't put too much stock into appraisals like that, frankly. But I mean, so, and then on the flip side, if you're buying performing notes, you're not buying a note. It doesn't, I mean, I'm not buying it at par, right? Although pricing has come up, I'm buying that at a discount as well. So normally speaking, I have my target yield. I don't want to say I don't care what the coupon rate is, but if I don't bid on notes that are 4%, like you said, but if it was 4%, I'm still looking for whatever my yield is that I want. So I'm paying 70% of the principal balance to get to that yield where the rate is 4%. So that is a huge benefit of notes, is discounted pricing and being able to, like you said, control an asset and now become the bank at a lower price point than if had I originated that note.
Ultimately, then at that point, it's just math. This is the unpaid balance. How much do I want to make in a quote unquote return over 10, 5, 15, whatever the term rate is on the note? Then I'm going to bid this if I want to make that. Jamie, you mentioned a term there, par. Can you tell everybody what par means, just in case they don't know?
Sure. Par is really just, the note, the principal balance is $100,000 and I pay you $100,000. So then I'm getting that coupon rate or the interest rate on the note itself. That's par. If I'm buying it under par, then I'm buying it at a discount, so I'm buying it at, say, for 85,000 versus 100,000, 15% off of par, I guess. Do you guys mind if I hit these last two slides real quickly? Do we have time?
Go for it.
Okay.
Do we also want to open it up for audience questions as well? Of course, you guys can always put it in the chat and we can read it off.
These are real quick. It's much less involved than the previous one. And this was a loan modification. And this was a 50-50 joint venture. So I had a kind of money partner, bought this note for $26,000. You can see the numbers here. Unpaid principal balance was $53,000. The borrower was actually making payments regularly, but she had fallen behind. She was 2 years behind. So I call this more of a sub-performer. We ended up modifying this loan. We got her on automatic ACH. She was paying. So we added to the principal balance. We lowered her payment. Where her interest rate was, as Matt alluded to, was 11%. And we lowered it to 8.5, I believe, and lowered her payment, extended her term. And I ended up selling this to a more passive note investor for $50,000. And that was the numbers are a little, I think in the next slide, it shows a lower yield IRR to him, but it ended up being about a 15% yield to this buyer who bought this note from me for his self-directed IRA. So we kept the borrower in her home by working out a loan modification. She was on a government assistance, government assistance with consistent income. She'd been paying consistently. The note seller who I bought this from was just distracted. And I took this and did a loan mod, kept it for 10 months, showed it as a reperforming loan she's paying. And I sold it for a good profit. Again, we lose money on deals. I'm about to lose a little bit in New York. So please don't think that I'm saying every deal is like this. But again, win-win-win. Borrowers in our home, note buyer from me is getting a passive automatic ACH investment into his self-directed IRA in this case. Could it go south again? Yeah, but there's equity there and he still bought it at a discount. So she still owes him more. The borrower still owes the note buyer more than what he paid me. So another win-win-win, I would say. My joint venture partner realized about a 60% annual return. Again, I'm using these as case studies because they were big wins. I have losses as well. So this is how you can reach out to me. I'll just leave that there and we can open it up for other questions.
Quiet on a Thursday. Hey, while we're waiting for other questions, I'll just thank you, Jamie. For next week, we're going to have Bill Extier on as well to present about exchanges. So now is a phenomenal time for everybody out there in the real estate market to look at, do they want to trade up or trade out of some of the appreciation that they've received over the past year and a half. Bill is going to talk to us about DSTs, Delaware Statutory Trusts, 1031 exchanges, and then also all the different other exchanges there are out there. So most people might not know that you can 1032, 1034, 1035, and all these different types of exchanges out there. So he's going to join us next week, same time, same place, to talk through all the different types of exchanges out there.
I just want to show you guys what Matt Four said about me, about my company.
Just glad you don't have my face up there.
No, we're actually trying to be successful. No, I'm kidding. I kid. Yeah, I mean, these were really good questions. Again, I think it's people sell the mailbox money, and it can be that, but is it? Am I swinging a hammer as a note investor? No, I mean, it's passive physically, but I will tell you, there are a ton of moving parts and a lot of detail to this. That's one of the most challenging things, is you really have to be organized and you really have to have your systems down.
All right, Jamie, can you share your contact information so that people in the audience, if they'd like to reach out to you, can do that?
Yeah, I would say go to our website, labradorlending.com. You can email me at batemanjames@labradorlending.com. It is a long email address, but our website is going to be redone within maybe tomorrow. And so I would just say labradorlending.com is the best place to go. You can reach out to me or send me an email. I'd be happy to connect or answer any kind of questions that anyone has. And again, if you do want to learn, somebody was probably about to jump in, but Notes and Bolts from the Good Deeds Note Investing Podcast is our Facebook group. The Good Deeds Note Investing Podcast comes out every Wednesday. Matt was on it, which was a really good episode. And you were challenging Chris on infinite banking. I remember that. And then, so I definitely, our podcast, I am biased, but we have the most consistent podcast in the note space. And frankly, I think it's the best. And if you go back over, I mean, we're very consistent every Wednesday. We have a really good guest, or it's just Chris and me, shooting the breeze. So yeah, I want to thank Matt. Thank you guys for having me. I really do appreciate it. The timing was great because I didn't have to, I had content ready to go.
All right. Thank you for coming in, Jamie. And could we ask everybody on the call to take themselves off mute and give Jamie a big thank you for coming in and talking to us today?
Thanks, Jamie.
Thank
Great
you,
job.
Jamie.
Nice work.
Thank you, Jamie.
Thank you.
Thank you, Jamie.
Thank you.
Everyone is welcome.
Yeah, thank you, Jamie. And for those that want to stay on networking, we'll start that shortly. It'll be a quick, 8 minutes breakout room with 6 to 7 people per room. So if you want to stay on, feel free. If you need to drop off, feel free as well. But that call will not be recorded. It's just going to be you guys networking. So is there anything else the host want to let the audience know before we go to the breakout room? Otherwise, we'll see you guys on.
One more thing, actually, if you want to get a copy of the recording or view this again, it's going to be available in our Facebook group. So just look for Real Estate Investing for Busy Professionals.
Just
Matt
dropped it
has
in the
linked
chat
it
too.
in the chat. Yeah.
Oh,
Perfect.
okay, perfect.
Great. Awesome. I'm gonna stop the recording.